Welcome to Momentum Investing, property investing made easy. One of the world's top podcasts on property investing, bringing you the top experts in the field so you can learn firsthand what it takes to create passive income and take control over your financial future.
Welcome to the Momentum Investing Podcast. I'm your host, Daniel Wood, and I'm very excited to welcome you to today's episode. We have a very exciting guest. One of the things we've talked about on a lot of these podcast episodes is about raising finance. But a question that keeps coming up is, once I have the finance, how do I structure my company? How do I pay tax? How does the investor pay tax? And these are very important questions. How do I make sure I have the right contracts in place? How do I make sure that I'm safe? How do I make sure the investor's safe? And how do I make sure that I'm doing things legally? Well, for that reason, we asked my accountant, Jeffrey Bohr, to come on this episode and share with us some of the details that we need to think about when doing investments and bringing on investors. How can we structure our company in a smart way that will allow us to work with these investors? Now, this was a very exciting episode to me. I learned a lot, and what I'm looking forward to is also discussing this in a future episode with a mortgage broker, because there's the exciting part of building your team. You know, in Momentum Property Education, we teach property investing. We have our mentorship program, and in that program, we provide the best sourcing agents in the market. We provide the top accountants, the mortgage brokers, the solicitors, everyone you need. So a question I often get is, well, if I have this team, what do I need to do? Well, what we're gonna do now is one of the parts that you need to do. We're gonna be talking today in today's episode with Jeffrey Bohr about the accountancy. This is gonna be very, very powerful, and I promise you're gonna learn a lot. Now though, I'm going to invite on a mortgage broker for a future episode, allowing him to comment on the thoughts that Jeffrey had here in this episode. That will create a very interesting conversation, I believe, and allow us to learn and take it with me. And this is your job as a property investor, to go to one of your team and get the info. Then go to someone else in the team and say, hey, mortgage broker, what does the bank say? Will this actually work? And then go back with that information to the accountants and say, look, this is the feedback I got. We got to restructure, or this will work perfectly. And keep working on it. So that's your role as a property investor, to make sure that these different interests work together to build a company that is perfect for you. And that's why there is no one size fits all. Your company will be unique in that you'll be taking in investors from different places, different sizes, and different structures for different deals. And that is what makes you unique, and that's what makes you special as an investor. This is what we try to teach in our mentorship program. Obviously, if you're interested in the mentorship program, you can apply to join. You can apply to become a mentee at getmomentummentor.com. Yeah, that's a lot of M's in there. That's getmomentummentor.com. and you can apply to join, and we'll show you exactly how you do this, how you raise finance, and how you become successful. But now, with no further ado, let's invite Jeffrey Bohr and let's learn how we structure our company for the best possible results. All right, we're here with Jeffrey Bohr, who happens to be one of my accountants. He is amazing at what he does, and I'm really happy to have him here to help us figure out how does it work. Once we get our investors on board, what do we do? So Jeffrey, thank you so much for joining us.
It's a pleasure. Nice to see you this morning, Daniel.
Yeah, right back at you. I appreciate you taking the time. We get a lot of questions from our listeners, from our clients, from our partners about, when you bring on an investor, how does it work with taxes? Do they have to declare? Do we declare? What forms? And all these kind of the accounting details that no one other than an accountant wants to know, but we kind of have to know. So please, can you shed some light on this process for us?
Okay, right. The first thing is, if you're going to start investing in the UK and you're going to do it through a UK company, the important thing is that the company has got to be registered in the United Kingdom, and it's got to be resident in the United Kingdom. Yeah. Now, there were some fairly recent tax cases on actually residence of companies. I'm just slightly diverting here, just to make sure people get a good understanding of what needs to happen. Merely setting up a company in the United Kingdom and having the registered office in our office, for instance, which is quite common, doesn't necessarily mean that the company from a UK tax point of view is resident in the United Kingdom. And that does have some quite serious consequences, because it could be deemed to be resident. If you're Swedish, it could actually be deemed to be resident in Sweden, even if it's a UK company. Now, to avoid that problem, what is important is that the central management and control of the company is seen to be in the UK, which basically means that from time to time, it is quite important that meetings are carried out in the UK. You could have meetings with other people. They could be based on Zoom. It could be based, but there's got to be some evidence that there is central management and control being carried out in the UK. Now, clearly, if you have UK properties, there's a very good chance that you're going to be coming over anyway to the UK to view the properties, to discuss with the agents and mortgage lenders and banks, etc. And it's important that at that time you keep records of all the times that you visited the UK, all the times that you had correspondence, emails, etc. So that if we do get questions from the UK Revenue to confirm that it is resident in the UK, we've at least got the evidence to support that we're saying that it's resident in the UK. Now, having assumed that we're okay with UK resident companies, what therefore happens when you set up a UK company?
Well, let me just stop there, question here, because I think that's going to awaken a lot of questions. So obviously a lot of our listeners are internationals. They might live in Denmark, Sweden, Norway, Germany, Italy, South America, Africa, Asia. So we have listeners from all over the world. And the one thing we kind of have in common is we want to buy property in the UK, right?
Yeah.
And so would it be enough to say, for example, for myself now, I obviously live in Sweden. So does Gisela, my wife and business partner and boss, obviously. And so when we're investing in the UK, we bring in a local sourcing agent. We're buying a property in the UK. We have a project management team in the UK, but they're not actually a part of the company. They're just subcontractors. All decisions are really made here in Sweden by me and Gisela, but we're making decisions together about the UK deals, about stuff going on in the UK, and we have meetings with our UK partners, even though we do it digitally through Zoom, especially now in the whole climate that we're in. Where does that line go? How, are we defined as we're a Swedish company that's buying, or are we a British company?
In that situation, because you have so many contacts with the UK, because you've got agents in the UK, you'll have contracts with them governed by UK law. You will have meetings with them, you'll have Zooms, you'll have, very often, if you have international investors, it will be automatically central. You can't have a company that's that has an investor in, say, in Portugal and another one in Sweden, and it's got a property in the UK. There's every reason why you would have meetings, and contracts would be governed by UK law. That will be sufficient to convince the UK Revenue.
So essentially, the fact that we own a property in the UK makes it very hard to say it's a company anywhere else in the world.
Correct, especially when you've got agents here that are managing the property, they're taking decisions about the property. You know, they may tell you, yes, we need a repair doing, but they're on site, they're doing the information. It's not remote, it's definitely on site. And therefore, because you've got some control in the UK of the property, that will be sufficient.
Okay, good. So we'll say that. So the listeners, we've set up our company. We have these things set up. We're starting our UK. We've started our UK limited company. We're buying property in the UK. So we're obviously a resident of UK as our company.
Yes, absolutely. Right.
Very
so we have an investor that comes in from overseas. There's two ways that they can invest in the company. Assuming that we'll talk about the directorships, etc. shortly, but from an investor point of view, there's two ways. A, they can invest in the share capital of the company, or B, they can do it by way of loan.
And just so everyone listening is with me here, the terminology we usually use is either they're a joint venture partner, right? They buy shares in the company, they become a co-owner, they become a partner, or they're lending the money through interest. A lot of us call that an interest, an angel investor, or just an interest loan. Just now everyone knows what you mean.
And of course, the ideal situation may well be a combination of both. So that you have an investor that puts in, say, I don't know, £100,000. They may put in, and we would keep the share capital relatively small, £500 in shares and £99,500 in loan capital. Now, the reason for doing that is because putting money in as share capital into a company, it's much more difficult to extract it out of the company than it is by way of a loan. So a loan is very simple. You would have a loan agreement. The loan agreement would determine the repayments with interest rates, etc., security, and all the rest of it. And that's much easier to get back out. Now,
and that's also, even if you do it as a joint venture, you can do that. You just set the interest rate to 0 instead.
Absolutely, yes. You can set the interest rate to 0.1% of a base rate, and base rate at the moment is 0.1%, so you're going to be paying 0.2%. So, who cares about 0.2%?
Yeah.
So the important thing is that money is coming in by way of loan is not taxable in the UK. Neither is the repayment of those monies back out by way of
so the principal, the money they put in, they can pull out tax-free.
Tax-free.
Yeah.
Whereas if you got money in by way of share capital, then the only way you can get the money out is either by way of dividend, and we'll talk about the tax implications.
Right, either a dividend or selling those shares.
Or the company can buy back the shares. Either way, the latter two are far more complicated because you need all sorts of resolutions to buy back shares. It's not an instantaneous solution, and it's depending upon the reserves of the company, depends on whether you can do it or you can't do it. So flexibility is keeping share capital to a minimum, putting it the more in by way of loan. Now, the only caveat to that is that if you are having to lend or go to a bank to borrow money, the bank may want to see a certain minimum amount of share capital.
Right.
But quite often, by way of loan, subordinating loans to banks is sufficient for most banks in any event. So that's the way of getting into the money into the company. Now, clearly, depend on how you have your investors or your joint ventures. You may be controlling the company, and you may have a number of people coming in as, in a sense, subsidiary joint venture agreements with you. We can, in the UK, issue all sorts of different types of shares. We can have ordinary shares for the original investors, and then anybody that comes in subsequently could have an A share or a B share or a C share, however you want to designate it. And those particular shares would have different rights within the company. So they may have restricted rights on dividend, they may not be able to participate in the capital of the company, and they may not be able to participate in the management of the company. That is completely flexible. It's how you set it up as you get on, how you set it up with your joint venture partners, whether it's equal or whether, for instance, we have
an interesting question there. Is say that I'm going to use me and Gisela as an example. So say we set up a property company, and then I find this deal. I find an HMO in Hull, all right, and it's going to cost £100,000 all in to do, and it's going to give a great, nice cash flow. And so I go to an investor and I say, all right, I want to bring you in. You have £100,000. You're going to get to pay for this deal. Nice as I am, right? And we're going to split the ownership 50-50. Could I know I could do that through a joint venture contract and a deed of trust, but could I also do that? I create a B-class share that essentially has a 50% ownership.
You can have a B-class share that says that it has a 50% ownership. Let's say, for instance, your company has got other properties in it, other investments in it.
If I could specify B-class shares is Hull HMO, this address, title number.
Exactly. So you can have a B-class share that says this shareholder is entitled solely to the profits as defined arising from property in Hull, whatever.
So as an accountant, would you see that as easier or more complicated than just writing a joint venture contract and having a deed of trust on the property?
That is slightly easier.
Okay, so it would be easier to just create a new class of shares for it.
Yes, to create a new class of shares is a very simple resolution. The beauty of a new class of share is that when you create it, you file the document with Companies House, and within the document that you file at Companies House are all the details of the rights and restrictions of that particular share. So in 7 years down the line, when you may fall, these things happen, you may have a disagreement with the investor, and he says, wait a second, I thought I was getting a share in the whole of the company. It's very simple. You say, well, absolutely not, because if you look at the article,
you got 50 B-class shares. Yeah,
it's very, very simple. And if he takes you to court, the judge will very simply turn around and say to the investor, you're not naive. You're entitled to look at the company's records at Companies House. You fail to do that. That is not the company's problem. That's your problem. And case dismissed. So you are protected, and the investor is protected because he has his rights set out at Companies House. So it's an open document.
Very cool. Okay, so essentially, I could have a property company with, say, I create 100 ordinary shares for me and Gisela, and then I have 20 different classes of shares, and I say, look, each one will be for a specific property, and I'll create 50 B class shares, 50 C class shares, D class,
Absolutely.
and then at the end, they have their rights and whatever it is. And essentially, I can still say, well, I own 100% of the company. Essentially, it becomes like putting together a bunch of SPVs, but never pulling them out of the business. It's just under one house.
Correct. And all you would say is in your B shareholder, that part of the arrangements with a B shareholder would be that they participate in the profits arising from property in whole.
Exactly, from that property or more if they put in more.
Once the property is disposed of, then the profits that are repatriated to the B shareholder, and the company will buy back at par or whatever value is agreed, the B shareholder. So the company is sold, the company cancels his B share, and you carry on with the DE, whatever other shares you've got.
So another interesting question here then, because now we're getting into, because this is like creating a whole company structure within one company. So
exactly.
What would be the pros and cons of doing it in one company compared to actually having an umbrella company and then multiple businesses below? So instead of creating the B class shares, I just create company, I just create a little company that buys the whole property.
Well, there's a saving in cost.
Right.
B, because it's all within the one company, we'll get a certain amount of group relief effectively. So there'll be savings in setting up the company. There'll be savings in bookkeeping.
Will be cheaper.
Accounts will be cheaper. Well, yes, it goes against us, but there you are.
Yeah.
It depends on the sort of properties and where the risks are within the property. If you have a property where you're borrowing and there may be risks that property may go down, you may well want to have it in a separate subsidiary company.
Right, because otherwise the risk is that it pulls out.
Correct. The risk is exactly because you've got it within the company. So that's the implications of it. But of course, you've got to be looking at the commercial aspects as well.
Yeah, that's a great point. Because we've actually been looking at in a company that we've actually looked at creating multiple SPVs for separate property deals, so it looked like on first glance that we would have the benefit of, we create that separate security, but we have one line of credit really for all of it, and they are going to have a floating charge against the mother company. Basically, meaning, obviously they have a charge against all assets, which means so I'm going to step back a little, because now I noticed I got a little technical here. So I'm going to step back for the listeners and just say, so essentially what Jeffrey has pointed out is a very interesting way of setting things up. So you set up one company that you can set up one company that is then subsidiary companies. Each subsidiary, meaning it's a company owned by the main company, is its separate entity, and it buys a property. Now, if something goes wrong with that property or the bank forecloses on the mortgage, it doesn't affect the mothership company. It kills the small company, right? So if you have 10 deals, and one of them goes wrong, just that deal dies. The other 9 stay alive. But if you do everything in this mother company and you do it with these classes of shares, then it's cheaper, it's simpler, it's all in one company. But if one of the deals goes down, the other 9 might have to pay the bank to save it, and the whole ship can fall. Now, what I was doing was this first alternative. I'm setting up a company with multiple subsidiary companies. And so on surface, it looks like the safer bet, but more expensive. But we have something called the floating charge based on the main company, which means it has a charge. They lend to the SPV, as we call it, the company started, the daughter company, so to speak. They have a charge against the property we've bought there, but they also have an additional charge against the main company. Means if the daughter company fails and doesn't pay off its whole debt, they then come after the mother company. So it essentially means they got a charge against everything, and they can make the whole thing fall. So in that case, it would probably be beneficial for us to just do it through one company with different classes of shares.
Correct. Because you're not getting the protection of the different.
I'm not getting the
limited
protection, and all I'm trying to do is pay extra money right now.
Yeah.
Right. Okay. So that was a great insight.
Yeah.
So guys, I'm learning too here. This is awesome.
Now, of course, the caveat of all that is it depends on the individual investors that they may want a separate company for their very own reasons. So you may have a subsidiary where they're holding their shares directly, and your main company holds shares in that subsidiary. So it really depends on individual negotiations.
And that might be one of those cases where you say, well, if we're going to do that, you got to put in enough money into that SPV to make it worth my while because I have a cheaper alternative kind of thing.
Yes. Yeah, that's right.
Cool.
Okay.
All right. So now, hopefully, once we do this, we figure this out. And guys, have a meeting with your accountant. Like I'm having a meeting with my accountant, like literally, and and learning a bit about these setups. So when you're going to do this, talk to your accountant, discuss these options. You now see new options that I didn't even know about before this call. So this is really, really good. Now, hopefully, this goes well and the deals go well and there's profit to be had. Now, a lot of questions come from the investors. If they're companies, how does it work? And if they're private individuals living in other countries or living in the UK. So these kind of three scenarios. If the investor is a company, if the investor is a foreign investor or a local British investor, how do they tax? How does this work?
Right. Okay. Let's deal with the part of the investment which is the loan.
Yeah.
So let's say, for instance, we have an arrangement where we're going to pay interest on the loan. Very simple. Bear with me 1 second.
Yep.
No, I'm in a meeting. Right.
All right,
Sorry about that.
Have a seat and we'll cut it out. So that's not a problem. I'll have our editor cut that. So just before, go back to let's deal with the loan and start from there.
Right, let's deal with the loan. Okay. So we have a loan and we're going to pay interest. If we pay interest to a UK resident, there's not a problem. We pay the interest.
Oh, wait, Jeffrey, correct the camera a little and then start over again. Just get the camera. Yeah, just get the camera. Yeah. There we go. All right. So let's start with the loan and go from there.
Start with the loan. Okay. So we're now going to pay interest to a UK investor. Very, very, very straightforward. We pay the interest to the UK investor. There's no deduction at source. The UK investor gets the interest paid by the company gross, and the UK investor records that on his own tax return and subject to UK tax the normal way.
So for us as a company, all we do is we've said, I'm paying you 6% interest. You gave us 100,000. Here's the end of the year. Here's 6,000 pounds. And then we don't have to think about it anymore.
No, correct. For a non-resident, for a non-UK resident investor, we have two options. The company can pay the interest under deduction of tax. So it deducts 20% tax at source from the investment.
Right. So essentially there, in my 6,000 pound example, I take 1,200 pounds and I pay that to HMRC, and I take 4,800 pounds and I pay that to the investor.
Right, and you pay that correct, and you pay it to the revenue on a quarterly return on a form called a CT61, which the revenue automatically issue once they've been notified eventually.
Right.
As far as the investor is concerned, in his own tax return, he will show the interest as gross. He'll show the tax that's been deducted in the UK, and under the double tax treaties, he should be able to get a credit for that tax that's been deducted in the UK.
Right. And will we get like a receipt from HMRC that we can give him to give to the, for example, Swedish tax authorities?
What you get from the UK company is I think it's a form R185, which shows on an annual basis the tax that's been paid and the gross interest that's been paid, the tax that's been deducted, and the net interest that's been received, and that will be included in the individual's own tax return as evidence of the tax deducted at source.
Right. Okay.
Now, the alternative way is that the investor himself, the non-UK resident investor himself, can apply to the UK revenue authorities under a form DT personal, it's called.
Right.
DT personal, where the application is made to HMRC here, once it's successful, the revenue here will advise the company that they can pay the interest gross to the investor. And once that's the case, then the company will pay the interest gross to the investor, and the investor then returns it on his own tax return in his country of residence. So you've got two options.
Right.
It's easier from a company's point of view just to deduct the tax at source, but the individual investor may, for whatever reasons themselves, they may want to apply to the UK authorities to get tax deducted, not to be deducted, to be paid gross to them.
Right.
So that's
you
interest.
can just have your accountant send them that form, and then they fill it out and send it into HMRC.
Correct. Now, as far as dividends are concerned, they're treated slightly differently. And each company is depending on the residence of the individual. So, for instance, if somebody's resident is in Sweden and they get dividends from a UK company, then the double tax treaty is actually quite interesting, because what it says is that the UK may deduct withholding tax at 5% off the gross dividend.
Right.
But several years ago, the UK scrapped grossing up of dividends. So, in practical terms, the dividend that a foreign investor receives from the UK has no withholding tax deducted in the UK.
Right. So they just bring it up on Swedish or Finnish or Danish.
Correct. You pay a dividend of £500 from the UK. £500 gets paid to the shareholder in Sweden, and then they record that on their tax return.
Right. And then it's up to them. So me as the company that's paying them, I don't have to think about it. I don't have to care about their tax return. It's up to the investor
Correct.
to declare, I made 500, 10,000, £1 million. That's their responsibility, not.
Correct. That's their responsibility. So right. that's very clearly how dividends work and how interest works. Now,
again, sit down with your accountant. So when you're listening to this, sit down with your accountant, discuss this for how you set it up. But as you see, if it's a loan at interest, that's where you pay withholding tax, unless the investor applies with the DT personal. If it's a dividend, if they're co-owners, if they're a joint venture partner, be it in your whole company or with this cool multi-class share structure that we talked about, then you don't pay withholding tax. But in either case, the investor has to bring it up on their own local tax return at the end of the year.
Now, the same thing applies if it's a company in Sweden that's applying, the same thing that applies exactly the same. The company itself can apply to the UK to get the interest paid gross. So it's the same system, and it's as simple as that.
That's awesome. That's awesome. I really appreciate this, Jeffrey. This was really, really powerful. I think we're going to leave it at that for now, because everything else really gets into like the details of the individual's company and investor. So I would recommend everyone who's listening to this to give Jeffrey, send him an email, reach out to be able to get your individual advice. So Jeffrey, I know everyone wants to reach you. The question is, how do they do it?
Right. Well, the best way actually is either through my email, which I shall give you. It's Jeffrey, all lowercase, JEFFREY, followed by a capital B for Bertie, and it's the name of the practice, which is Shacter, SHACTER -Cohen, COHEN -Bor, BOR.com. Or
I will add this in the show notes. So if you didn't keep up, but I'll repeat it. It's Jeffrey, which is JEFFREY, capital B. So Jeffrey B at Shacter, which is SCHA.
SHAC.
Oh, okay. So no C. So SHACTER -Cohen, which is spelled with a C, -Bor, which is just BOR.co.uk.
.com.
.com. Oh, it's even .com. See, everyone else is .co.uk. So remember, that's .com. I will write this in the show notes, so you don't worry that we're all confused. I will write it and I'll get it right. So you have that in the show notes. How else can they reach you?
They can reach us by phone, or I'll give you our office number, which is a UK number, which is 0161 236 3909. Or if they Google us, they'll get onto our website. Just put in Shakhtar Conan Ball and we'll come up.
Perfect. And I'll have all these links to the website, phone number, and that very complicated email. I'll put there in the in the show notes so you can reach Jeffrey. So if you have any questions about these details, reach out to Jeffrey. He and his partners, this is what they do. This is what they help us with. I just had another insight now, so that was great. So I'm going to reach out to my business partners because we're just getting into the structure part and we hadn't yet reached out to Jeffrey. I thought it was a great opportunity to do it through the interview, and we'll restructure in our business plan. So it's really cool.
Brilliant. Super. Thank you very much.
Thank you so much, Jeffrey. Thank you for joining us. Thank you, everyone who's listening. Stay tuned. I got some exciting news before we wrap up this episode. So thank you so much for listening, and I'll speak to you soon.
Thanks. Bye-bye.
Thank you so much for watching. I hope you enjoyed that as much as I did. As you can see, I was in there learning, thinking about how I could restructure my business. And this is what's so great with having a good power team. They always have things to teach you within their niche. And that's where we went deep, obviously, now with Jeffrey, and learned how we can structure our company differently. That means we don't have to buy the expensive joint venture contracts, the deeds of trust. Instead, we do it through the shareholder agreement. Now it's time for us to take the next step as a property investor and take that responsibility to see, well, if this first part works best for the accountant, will it work with the banks, with the mortgages? Will it work with our entire business structure? So that's why we're now going to turn, and in this coming episode, coming out next Tuesday, I've invited back one of the best mortgage brokers in the United Kingdom, Richard Ignatowicz, to tell us how this would work in practice. So he's listened to the episode, and we're going to sit down and look at how would the banks look at this? If they like it, how can we use that to greatest effect? If they don't, what can we do differently? This is really how you work as a property investor, going from different people in your power team, getting information and putting it together into that perfect system. So you're kind of getting to join me as I do this on my deals right now. So that's really, really fun for me. I hope it's fun for you. So make sure you subscribe to the Momentum Investing podcast and you follow along and see now what Richard says about this amazing setup that would save you money, would make it easier, quicker. Well, let's see if the banks agree. Let's see if this works in practice. So make sure you subscribe to the Momentum Investing podcast. And if you want to get access to the entire power team that we provide at Momentum Property Education, as well as contracts for investors, for builders, as well as the education, you can apply to our mentorship. It's at www.getmomentummentor.com. Or if you're just starting out your property journey, you can go to momentumgift.com and we'll teach you the 3 simple steps to property investing. That's completely free. Get at momentumgift.com or apply to join the mentorship at getmomentummentor.com. So I'm looking forward to seeing you there. Next episode is going to be really, really exciting. I'm super excited. I hope you are as well. So I'll see you on Tuesday.